Everyone wants to own a piece of the earth, but what happens when that piece of earth is priced at 3 times its actual value? In 2008, the world watched in horror as the housing market collapsed, wiping out trillions in wealth almost overnight. Today, home prices are hitting record highs again, and the question on every investor's mind is, are we in another bubble? Today, I'm giving you the 4 red flag metrics to help you spot a real estate bubble before it pops. Welcome back to Finance Files. We've already explored passive income apps and the showdown between real estate and dividend stocks. But as a sophisticated investor, your goal isn't just to buy assets, it's to buy them at the right price. This is our latest entry into passive income strategies. By the end of this video, you will know how to look past the hype and use data to determine if a market is a gold mine or a minefield. Section 1. The price-to-income gap. The most reliable indicator of a bubble is the relationship between home prices and local wages. In a healthy market, the average home costs roughly 3 to 4 times the average annual salary of the area. When that ratio climbs to 7, 8, or even 10, as we are seeing in many major cities today, it's a massive red flag. If the people living in the city can no longer afford to buy the houses in that city, the market is no longer being driven by utility. It's being driven by greater fool theory. Eventually, you run out of fools, and the prices must correct to match the reality of local incomes. Section 2. The rise of the speculator. Bubbles are fueled by psychology, not just math. In a normal market, people buy houses to live in them. In a bubble, people buy houses because they think they can sell them to someone else for more money next month. This is speculation. Look at the percentage of homes being bought by investors rather than owner-occupants. When you see fix and flip gurus all over social media and your Uber driver is talking about their 3rd rental property, the FOMO has reached a fever pitch. As we discussed in our Wealth Builder Blueprint, following the crowd is rarely the path to sustainable wealth. Section 3. Inventory and days on market. Real estate is ultimately a game of supply and demand. In a healthy market, there is usually a 6-month supply of homes for sale. In a bubble, inventory often drops to less than 1 month, leading to bidding wars where people waive inspections and pay thousands over the asking price. However, the first sign of the pop isn't prices dropping, it's inventory rising. Watch the days on market metric. If houses that used to sell in 2 days are now sitting for 30 or 60 days, the tide is going out. The demand has dried up, and a price correction is the only way to move the remaining stock. Section 4. The interest rate stranglehold. Real estate is the most debt-dependent asset class in the world. Most buyers don't care about the total price. They care about the monthly payment. When interest rates are low, people can afford massive mortgages. But when rates rise, as they have recently, that same monthly payment buys a much smaller house. This creates a stranglehold on the market. Sellers don't want to lower their prices, and buyers can't afford the higher rates. This leads to a frozen market that eventually breaks when sellers are forced to liquidate due to job loss or relocation. Real estate is a powerful pillar of passive income, but only if you buy when the math makes sense. If you want to see our deep dive into how to buy your first rental property without a massive down payment, hit that like button and subscribe to Finance Files. We are building the most data-driven community on YouTube. I want to hear from you. Do you think your local city is in a bubble right now? Or is this just the new normal? Let's debate in the comments.